Inflation is hitting hard. Rates are the highest they've been in 40 years, and it's affecting all parts of the economy, from the grocery store to the gas pump and the cost of housing. This is Inflation Explained. Inflation is a decrease in the purchasing power of money, reflected in a general increase in the prices of goods and services in an economy. The rise in prices means that a unit of currency effectively buys less than it did in prior periods. Inflation can be contrasted with deflation, which occurs when the purchasing power of money increases and prices decline. An increase in the supply of money is the root of inflation, though this can play out through different mechanisms in the economy. A country's money supply can be increased by the monetary authorities by printing and giving away more money to citizens, legally devaluing the legal tender currency, and loaning new money into existence as reverse account credits through the banking system by purchasing government bonds from banks on the secondary market. This is the most common method. In all of these cases, the money ends up losing its purchasing power. High and variable rates of inflation can impose major costs on an economy. Businesses, workers, and consumers must all account for the effects of generally rising prices in their buying, selling, and planning decisions. This introduces an additional source of uncertainty into the economy. Investors looking to protect their portfolios from inflation should consider inflation-hedged asset classes, such as gold, commodities, and real estate investment trusts. Inflation-indexed bonds are another popular option for investors to profit from inflation. Additionally, special financial instruments exist that one can use to safeguard investments against inflation. They include Treasury inflation-protected securities, low-risk Treasury security that is indexed to inflation, where the principal amount invested is increased by the percentage of inflation. In the past, the crypto crowd has said that during tough economic times and inflation, crypto's the place to park your money. But it has not been the case so far. This is because most cryptocurrencies are worth basically what owners say they're worth. And if a lot of people take out their money during difficult times, then the value of crypto goes down. It's a tough decision to decide where to park money during inflation. Generally speaking, higher inflation harms savers because it erodes the purchasing power of the money they have saved. However, it can benefit borrowers because the inflation-adjusted value of their outstanding debts shrink over time. Inflation causes a nation's currency to decline. This can benefit exporters by making their goods more affordable when priced in the currency of foreign nations. On the other hand, this could harm importers by making foreign-made goods more expensive. Higher inflation may also encourage spending, as consumers will aim to purchase goods quickly before their prices rise further. Recently, many countries are facing growing levels of food insecurity, reversing years of development gains. Food prices increased sharply due to elevated input prices, which, combined with high transport costs and trade disruptions due to the war in Ukraine, are raising import bills. That hits poor and developing countries hardest, as they depend on food imports the most. Rising food prices have a greater impact on people in low and middle-income countries, since they spend a larger share of their income on food than people in high-income countries. Controlling inflation. A country's financial regulator shoulders the important responsibility of keeping inflation in check. It is done by implementing measures through monetary policy, which refers to the actions of a central bank or other committees that determine the size and rate of growth of the money supply. In the US, the Fed's monetary policy goals include moderate long-term interest rates, price stability, and maximum employment, and each of these goals is intended to promote a stable financial environment. Price stability, or a relatively constant level of inflation, allows businesses to plan for the future since they know what to expect. The Fed believes that this will promote maximum employment, which is determined by non-monetary factors that fluctuate over time and are therefore subject to change. For this reason, the Fed doesn't set a specific goal for maximum employment, and it is largely determined by employers' assessments. Maximum employment does not mean zero unemployment, as at any given time there is a certain level of volatility as people vacate and start new jobs. Don't forget to leave a like and subscribe for more. World of Finance TV has videos every Monday and Friday.